Hello and welcome to the Patient Portfolio. This channel is where I talk about my real portfolio, my thinking and the markets as a whole. A lot of investing content seems to me to be buy a global ETF and check back in retirement, which isn't a bad plan, but that's not what I'm doing. I'm thinking more about valuation and risk and where we are in the cycle and adjusting my portfolio to those things. This isn't financial advice, and there's a chance that you watch someone get lots of things wrong, but follow along and you can see how it plays out. Today I want to start with the idea that sits underneath my portfolio decisions, which is all about risk and reward. Because I think this is one of those ideas that sounds simple, but gets misunderstood all the time. What risk actually is, and how it connects to return. So in theory, risk and reward should line up. A simple way to think about it is something like roulette. If you put your money on black, you've got roughly a 50-50 chance, and you roughly double your money if you're right. If you bet on a single number, the odds are much lower, but the payout is much higher. Higher risk, higher reward. And investing is often presented in exactly the same way. You move from cash to bonds to equities and maybe even further along, and expected returns go up as you take more risk. At least that's the theory. But in reality, it doesn't really work like that. Risk and reward don't stay neatly aligned. You can take a lot of risk and get very poor returns, and you can take what looks like very little risk and do very well. So something else must be going on. And in my view, the thing that breaks the relationship is price. And once you start thinking about price, it changes how you define risk completely. Most people think volatility is risk. When prices are moving around a lot, it feels risky. And when things are calm, it feels safe. But those feelings are often completely backwards. The moments that feel the most uncomfortable are often the ones with the best long-term opportunities, and the moments that feel the safest are often where the risk is building quietly in the background. So volatility isn't really risk. It's just how risk shows up in the short term. So if volatility isn't risk, what actually is? Because most of what people think of as risk, volatility, price swings, short-term losses, that's not really it. The first real risk is overpaying, and the second is permanent loss of capital. You don't lose money because prices move. You lose money because you overpay. That's where the damage actually happens, which is why Buffett puts it the way he does.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule. And that's all the rules there are. I mean, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
Maybe that's easier said than done. And you can see this really clearly if you look at something like the dot-com bubble. At the time, it didn't feel risky. You had strong growth, new technology, the internet was transforming everything. There were good stories behind a lot of these companies, and prices were going up, which tends to make everything feel a bit safer. But valuations had completely detached from reality. And when that happens, the risk isn't obvious day to day, it's embedded in the price you're paying. So when the Nasdaq fell about 75%, it wasn't really a surprise in hindsight. The risk was already there. So risk on its own doesn't really tell you much. You can take a lot of risk and get a very poor outcome, or take what looks like less risk and do very well. What actually matters is the relationship between risk and price. You get rewarded for taking the right risk at the right price. A risky business bought very cheaply can be a good investment. And a very safe-looking business bought at the wrong price can be a terrible one. Let me show you what I mean. Imagine a business. Let's call it the Codfather. Just a solid fish and chip shop. Nothing fancy, but the locals love it. The only thing we're going to change is the price we buy it at. So, you can buy the Codfather at 130p, which is basically saying, I really like this. I'll pay up for it. Or 100p, which is fine. Or 70p, which looks like a bargain. Now, obviously, everyone would like to buy it at 70p. The problem is, it never feels like that at the time. If it's trading at 70p, there's usually a reason. Maybe the doctors are saying that fish and chips do not count as one of your 5 a day, and people are thinking of moving to Cornish pasties. Or maybe there's a cod shortage. So instead of thinking this is cheap, you're thinking this feels risky. And at the other end, 130p can often feel completely reasonable. There is a rumour that the fish and chip shop is going to develop its own AI, which tells you exactly how many chips you need. Suddenly, this business is a growth story, and the price has been going up, which always helps. So you're not thinking this is expensive, you're thinking this is a great business. And that's how you end up overpaying without it feeling like a mistake. And even fair value isn't fixed. What you thought was worth 100p might turn out to be worth 85p. So now even buying at 100p wasn't safe. You've actually overpaid. Now look at the outcome. If you paid 130p, you lose money. If you paid 100p, you might still lose money. And only if you had that margin of safety do you come out okay. So the cheap option never feels like the easy option, and the expensive option often feels the safest. Nothing changed about the business, same fish, same chips, same shop, just expectations and the price you paid. And that completely changes the outcome. That's where the risk is. You're trying to structure your investments so that if you're right, you do well, and if you're wrong, you don't get hurt too badly. That's what Monish Pabrai means when he says, heads I win, tails I don't lose much. And this is where it gets a bit more subtle. When people think about risk, they tend to focus on the obvious things. Recession, inflation, interest rates, geopolitics, all the things that are in the headlines. And those things do matter, but they're not usually what causes the biggest losses. What actually matters tends to sit underneath. Overvaluation, too much leverage, crowded trades, complacency. In other words, the biggest risks don't usually look like risks. They show up when things feel comfortable, when prices are high, when everyone agrees, when nothing seems obviously wrong. Which is exactly when people tend to take the most risk without realizing it. And one of the clearest examples of that is valuation. If you look at something like the current CAPE ratio, it's currently close to dot-com levels. Not quite at the absolute peak, but not far off. Now that doesn't tell you what's going to happen next. Markets can stay expensive for a long time. They can get more expensive. Valuation doesn't tell you what happens next, but it does shape the range of outcomes. Because if you're paying a high price, you're relying on things going well. Strong growth, high margins, continued optimism. And if any of that disappoints, that's when the downside shows up. Whereas if you're starting from a lower price, you don't need everything to go perfectly. You've got a bit of room for error. And historically, the starting point has had a big impact on the returns you get. The chart shows the relationship between the CAPE ratio in a number of markets and subsequent returns. When valuations have been high, future returns have tended to be lower. And when valuations have been low, future returns have tended to be higher. It's not a perfect relationship, and it doesn't tell you anything about the short term, but over longer periods, it's been fairly consistent. It's not a timing tool, but it is a useful guide. Another way of looking at valuations is just to ask how often markets have been cheaper than they are today. And by a lot of measures, it's most of the time. Depending on the metric, and none of them are perfect, American markets have been cheaper a lot more times than they have been this expensive. And American markets drive much of global markets. Now again, that doesn't tell you what happens next. Markets can stay expensive, they can get more expensive, but it does tell you something about the odds. And investing, at its core, is really just about playing the odds well. And that's where behaviour becomes really important. Because even if you understand all of this, it's still not that easy to act on. When markets are expensive and going up, the pressure is to be involved. Everything feels like it's working. Everyone seems to be doing well. And when things are cheap and falling, that's usually when people are most uncomfortable. So the natural tendency is to do the opposite of what actually works, which is why Buffett puts it this way. The market is basically a device for transferring money from the impatient to the patient. And patience is much harder than it sounds. So the question is, what do you do if you think along these lines? For me, it really comes down to a few simple ideas. The first is just to focus on valuation, to spend more time thinking about what I'm paying than trying to predict what happens next. The second is to demand some kind of margin of safety, to avoid situations where everything has got to go right, and instead look for ones where things can go a bit wrong and you're still okay. The third is to think in probabilities, not in certainties, not in predictions, but in ranges of outcomes, and the odds attached to each of them. And then the last one is patience. Because some of the time, those opportunities just aren't there. But you can wait for them to appear. No one is forcing you to buy a market that is expensive. You can't control the future, but you can control the price you pay. And that's really how I'm trying to think about my own portfolio right now. So that's my framework. How I think about risk, how I think about price, and how I try to approach decisions. Now, the interesting part is how that actually plays out in a real portfolio. Because all of this sounds quite sensible in theory, but investing is really about what happens over time. So in this channel, I'll walk through my own portfolio, what I'm doing, what's changing, and why. And some of it will probably work, and some of it probably won't. But at least you'll be able to see the thinking. So if you're interested, you can follow along and see how it plays out.